Good morning. My name's Jason Gerlis. I work at Ocorian, running our corporate services practice. I'm here with my colleague Vince, who heads up our North American growth, and Ruth, who's joined us from Greenberg Traurig. We're here today to talk about the explosive growth in private credit and what we're seeing from a legal side, Greenberg Traurig, and from an Ocorian perspective as a leading provider of services to asset managers. We're going to cover off a couple of different topics today. So firstly, what is driving that explosive growth and what we're seeing in the market. Secondly is Cayman as a structuring jurisdiction, why that's used and how it benefits asset managers and their LPs. And then thirdly, the different types of structures that are used, the benefits and the considerations that asset managers and their advisors should be considering. So at Ocorian, we support asset managers from all different perspectives throughout their life cycle. So everything from structuring the SPVs and entities that they need to raise and deploy capital, providing them fund administration, as well as outsourced CFO and chief compliance officer services. The US is a very important market for us because over 60% of the assets under management that we see in the private credit space are here in the US. So we have the privilege of working with lots of managers, big and small, through different phases of their life cycle. So we're excited to talk about today's topics. So to kick us off, topic one, what is driving the explosive growth in private credit? So I suppose maybe Vince, to kick us off, what are the macro and micro factors that you're seeing in the market that's driving this growth?
Well, first off, I think that there's a misperception that this is a recent past few years item that's provided this explosive growth that everybody's calling it. You really have to go back to the global financial crisis, which is over a decade and a half ago, when the banks pulled out providing credit to the both public and private markets. Private credit participants stepped in, pools of capital that continued to build across the past 17 years. So that's the first thing. Second is that several of the larger investment groups out there, let's call it the insurance companies, were really first adopters to this, but then following on the endowments and foundations, realized that private credit could offer the expected rates of returns that they needed for their constituents, while also matching off liquidity that was needed for their payments to those constituents. Wrap it up with just the general expected rates of return in the private credit markets versus public credit markets. And I think those three components over the last decade and a half really have been what's manifested into this explosive growth that people are calling the private credit industry here in the U.S. But it's really not explosive. It's been a steady climb from our perspective in practice.
People are just starting to take notice.
Correct.
Yeah, I echo that. I would add, I think the recent growth per se, when people talk about it, it's really, you see the growth in the type of deals people do, the type of assets people can finance, and the type of borrowers. I think historically, probably the middle market, I always call private credit are the people who are not financeable by the banks or traditional sense of lending, and then the private credit providers stepped in and start to finance them. But now this is really becoming more mainstream. That's what I would say when people. That's probably also why people just feel like, oh, we only start to hear about this in the last 3 years because it's becoming more mainstream.
Yeah. I mean, we work with a lot of corporates, and especially with the recent interest rates rising, people are looking for alternative access to credit. And I think that the private markets, as you say, are no longer an alternative. They're kind of the first port of call.
Yeah.
So there's almost a meeting of the need and the supply in terms of corporates who are looking to refinance, feeling a little bit of pressure in their capital stack. And then, LPs looking to deploy funds with GPs that are becoming quite comfortable with this investment strategy.
Yeah, and it's more tailored, both from the investor side point of view and from the borrower side of view. So it really provides a nice platform for East to meet the West.
I would just say we're in the early innings of private credit, especially here in the U.S., even with the explosive growth that's occurred, because I always like to look at analogs for what you're dealing with, and you look at what's the private equity markets have been maturing over the last 50 years.
Sure.
And so private credit maturing over the last 15, you're really still in the early innings of that game.
Yeah.
I mean, we work across all different asset classes, so private equity, real estate, infra, and it's fascinating how many asset managers are building out their private credit shops. So I have a friend who works in private equity, and he keeps saying to me, you need to tell me more about this debt piece because my firm's growing it hand over fist.
Well, and why are the private equity groups venturing into private credit? It's because the LPs are asking for it. So
Sure.
if you're not going to be able to provide that to that LP constituency, they're going to go someplace else. And then guess what? That group might start a private equity fund, middle market, lower middle market, that then they decide to invest in their next fund versus yours. So these groups are going to continue to build out their product offerings across credit.
Yeah, and I think as it's become more mainstream, LPs have recognized that private credit actually provides you with access to quite a reliable revenue stream. And assuming that it's been structured appropriately, and we'll come on to that later, and collateral's been put up, it can be a very secure way of balancing out your portfolio.
Yes, our clients are standing first in line,
Yep.
And so extremely well protected with loan to value ratios as well. And I think another macroeconomic development that's occurred over the last 50 years is we've gone from 8,000 public companies early 90s to 4,000 public companies here in the U.S., listed companies as of last year. And what's happened in the private markets, we're up to 19,000 private companies. So there's just more opportunity, supply demand, right? There's more opportunity to provide credit to private companies than the public companies that are out there today. So you're talking about 5-to-1 ratio. So it's only natural that private credit is going to continue to grow, just as private equity has grown, launching all those 19,000 companies over the last several decades.
Yep.
Yeah.
Makes a lot of sense. We've established that the market is growing. My second question is around investor expectations and what that means for fund structuring. So maybe Ruth, I'll pose that one to you.
Yeah, sure. So I work with Greenberg Traurig, and I'm a commercial lending attorney. So in the recent years, or well, actually last 10 years, that I've seen a lot of private credit deals evolves. Part of that is the market demand from the borrowers, and the other part is from the investors. So I would say the trend or the evolution is be driven from both ends. A recent deal I'm working on right now is actually a very interesting deal. The asset class is water rights. So I represent the lender. They finance water rights. The borrowers, they have water rights to extract to get water off the ground and sell to the city. And then, first of all, it's a very interesting asset class. And secondly, you can see how the negotiation going in terms of how our client can, make sure their investor is comfortable.
Sure.
And they can understand this asset class. They can properly underwrite it, and they can properly understand the risks. So in terms of structuring this deal at the deal level, it took like months to even get to the structure, because initially it's supposed to be like a holdco traditional private credit financing, and then because the special aspects of these assets, it took months to negotiate, and finally it's actually a very interesting, I would say, combo of all asset financing versus
Cash flow.
Yeah, cash flow. So we come up with a structure where the investor, because where the water right is actually on a piece of land, but that's at the opco level.
Okay,
So
yeah.
we are only getting equity pledge at the holdco and the first tier, but then that's really where the cash flow and the value is for this deal. So our client, we work together with them to come up with a structure where they will have a second lien mortgage on that piece of land. when there's a EOD or when there's some serious default, because another wrinkle to this, that piece of land is already had a first lien mortgage with like a what is called a farm credit lender. So this whole going back forth and structuring this deal, I think it shows how you tailor your deal, not only for your borrowers but also for your investors. So everyone gets what they need to be able to move forward.
With special considerations for specific asset classes and specific situations that different people find themselves in.
It will be a lot harder to. I'm not saying like bank finance is gone and gone. It still has its place and value. But imagine you put this forward on a credit committee of like a traditional institutional lender. I don't know. Maybe they will, eventually come to, agreement, but it will be a lot harder and longer.
Yeah, I think that's getting an X back on that underwriter's report. It's like we're not touching this. No, thank you.
Exactly
too many elements to it. Right.
It's not only secondly, it's sprinting. It's now you don't have it on day one. It sprints into action.
Yeah.
I thought it's a cool deal. We're closing next week.
Well, good luck.
Yeah. That's well, the whole point is you don't need luck when you're working with Greenberg. I think that's the point you're making, right?
What's that?
You don't need luck if you've got the right advisors.
That's it.
Yeah, good point.
But it's interesting, like these special situations aren't that special, because I'm assuming like water rights and the provision of those services is actually quite a big industry. So it might be seen as esoteric or risky from the bank's perspective. But when you're able to work with lawyers who are experienced in that particular asset class and GPs who are the same, it gives LPs the ability to invest into quite interesting areas.
Yeah, very good point you just made. From the market study, healthcare and the infrastructure are the top two as of 2025. The financing for private credit. So it is a growing area for the asset class that private credit providers are looking into.
Yeah, interesting. And Vince, from your perspective, outsourced CCO, CFO, fund admin?
What we're seeing from expectation differences, the investor letters are definitely getting longer. And I think that's because you've had a bit of a shift. You still have some of the early adopters of investing in private credit, like the insurance companies, right? They were there first because of the returns and the matching of liquidity that they required for their constituents. But registered investment advisors, like think traditional private wealth advisors, they've been coming to the private credit markets now, and where they're possibly pooling 25, 50, 100 of their underlying clients into a particular private credit fund. Those private clients have a different expectation of what's going to be reported through. So the transparency associated with the private credit fund and the underlying investments, I think, has increased significantly over the past decade, primarily based on the type of investor, not necessarily the investors changing over time. Does that make sense?
Yeah, no, it does. And I'm sure kind of exacerbated by things like ESG quotients and the ability to understand the impact of what you're doing. Again, back to Ruth's example with water rights, I mean, that could be quite a fractious field in terms of the environmental impact. And certainly, we're seeing that regarding our systems and processes when it comes to LP reporting. The demand is only getting greater from a regulatory and compliance perspective as well, right?
Yeah, for that specific deal, we actually are implementing monthly call with the borrower, with their management, in addition to just sending their financial reportings, because this is an ongoing project. Things are happening in real time.
Yeah, and the only other thing we've seen recently, fund formation side, is evergreen private credit funds being pulled together. So that's not something you saw a decade and a half ago. Thankfully now, the attorneys like Greenberg, they're matching off liquidity terms, obviously, with the underlying portfolio durations. But that's another thing we think we're going to see more of, so that they're not constantly going back out to market for Fund 3, 4, 5. It's really they've got a flagship evergreen private credit fund that can receive capital at any point in time.
Thank you both. So on to our next question. With North America accounting for almost 62% of assets under management, what should managers be considering in terms of that exposure? Maybe I'll pass that one to you first, Vince.
Yeah, it's a good question. I think it's a tricky question because people see 62% and like, oh my gosh, first thing that comes to mind is the trade over? Is it saturated? And as I said earlier, it's still in the early innings. Again, I like to go to an analog, private credit versus private equity. Private equity markets over the last 50 years, if you look at what's happened, public-private markets with equities, 50 years ago, if you took the first 25 leading into the tech bubble, more value creation occurred how? Via the IPO markets, right? So unlocking value and returning that to investors was done via IPO. The last 25 years of that 50, how's value been unlocked? It's been unlocked as the companies have stayed private longer, right? So private equity markets have been maturing, let's call it, over the last 50 years. Private credit hasn't been maturing over that same time frame because it needed private equity to start to mature first.
Sure.
So now we have the last 25 years of private equity, private companies maturing, growing their value across all these sectors. And what's happening now is private credit has started to mature, but it's still in the early innings, as I said, because you look at what's going on between a CFO at a private portfolio company, and they've got the ability to access the equity markets, like we've talked about, and unlock value, but they might want to, just like a public company, access the debt markets now, which have become much deeper, much more choice for them to to go and get preferential rates via those markets. So we see private credit maturing, after the private equity maturing. And if you just want to take numbers from one of our pieces that's going to be coming out in a few weeks, if you look at it from a private equity and private credit to public equity and let's call it corporate bonds, like global assets, we're talking. Public credit accounts for 23% of the public equity and public credit combined.
Yep.
In the private markets, private credit only accounts for 10% of that combined number. So private equity and private credit together, 10%. So it needs to catch up another 10, 15%,
Yep.
right? And then the added growth on top of that of what's going to happen with the maturation. So we see it in the very early innings. This is not a bubble of any sorts.
Not a flash in the pan.
Correct.
Yeah. And as we were talking about earlier, the private credit really becoming more accessible for a lot of different types of borrowers, different sectors of industry. So maybe the next thing, for sure it will catch up our regulatory regime. It's not just going to let it run on its own. So that will be an interesting thing to see how, the government, because if you think about it, now the exposure is way more extensive, right? So they're essentially slowly replacing what the institutional lenders used to do and covering those bases. So that's something I'm very excited to see, what the regulatory, once that kicking, what the market is going to look like and how much, really autonomy the private credit providers will still have.
Yeah, I suppose as the banks step back from this area, given they're SEC regulated, and then you've got the private shops stepping in, how are they going to manage the risk inherent in the system? Yeah,
and in addition, you guys probably see those deals, like increased numbers of deals, the banks and the private credit providers, they jointly
side by side.
Side by side. So
more syndicates.
It is very interesting trend. I think, just personally, don't speak for Greenberg Traurig, I think the next 5 years we will see a lot more regulatory
oversight.
Well,
I suppose, another impact of the North American market booming so much is that it's becoming more and more common to see US firms trying to raise capital abroad or foreign LPs looking to invest into this market. So that's another area that kind of increases the regulatory oversight, because we'll speak about it later. Then you have to start figuring kind of blocking structures and tax efficiency into the model versus pure play domestic.
Yeah, for sure. Yep.
Yeah, so I think, Jason, a question for you, right? We just talked about how in the U.S., private credit has been exploding, but it's really been a long march to where we are today. And because the U.S. is leading the private credit markets, oftentimes then European investors, APAC, Emirate investors want to then gain access to these markets. And from what we're seeing on our outsourced CFO clients is that the preferred jurisdiction for them to create blocker entities, set up parallel vehicles, continues to be the Cayman Islands. And
Sure.
so I know that's your area of expertise here at Ocorian. So what are you guys seeing in this maturation of marching of private credit up and up and up? Is it the same in Cayman, or is it manifesting itself a little differently?
Yeah, sure. I mean, we're lucky enough to have a very strong team in Cayman, both in terms of our corporate services and fiduciary elements, but also in terms of Ocorian law, so our sister law firm. I think that there are a few different factors that make Cayman the preferred blocking jurisdiction of choice. First and foremost, obviously, is the tax neutrality. Mm-hmm. So, if you are here in the US, the only two guarantees in life are death and taxes, I hear. But if you're not US based, there's no reason why you'd want to come under the IRS regime. So you do need a blocking structure to avoid kind of layered levels of taxation. But there are options, right? So why Cayman above the others? I think, first and foremost, from a legal environment perspective, it's a very well-tested regime. So it's been in use for the last 20 years. It's seen all sorts of asset classes, from hedge to infra to debt. It's seen funds through all phases of their life cycle. And it's also seen funds that have unfortunately gone insolvent and exploded. So I think that, as an investor, you can take a degree of comfort from the fact that the legal regime in Cayman is, not just written, but also tested to maintain the rights of all of the different counterparties, which, is ultra important. And I suppose linked to that really is a degree of familiarity. So the fact is that over time, LPs have gotten used to Cayman. So, both in terms of the GPs in the US and then the potential investors from abroad, Cayman is a structure that's been used. It's something that they're familiar with. And it's the old adage, if it ain't broke, don't fix it. So, if you're trying to raise capital, the last thing you want to do is have to explain your structure. Mm-hmm. You want to be focused on your investment strategy and the various guarantees around liquidity and surety that those investors are going to get with you. If you can avoid a further conversation around the structure, then you will. And that's why using Cayman is most commonplace, because the LPs are very familiar with it.
Yeah. And also, it's a lot easier to set up the whole process, right? You don't need a local director. You might need a local bank account. For some of those, tax favorable jurisdictions, you actually need to have a local, like someone physically local, before they even let you to establish a corporation. So that's very
to establish,
convenient.
You just need your registered agent. I mean, as things continue, you will need to have a domestic anti-money laundering officer. Hence, talking about some of the regulatory regimes and complexities. Yeah,
well, that's where you guys come in.
That's it. Yeah, well, it's easy when you've got the right partners.
Yeah.
But I think that Cayman has proven itself to be both a safe regime, but also a very investor-friendly regime. So it's built to do business. You can still incorporate same day. You can get these structures set up very quickly, which is ultra important given the time, cost, and money of some of these big funds.
Yeah. I mean, from an investor perspective, like you said, they really like to know, especially when things are not going well, what the outcome is going to be. I always give people a good example about pick your jurisdiction wisely. It was many years ago, is an ABL deal, asset-backed lending. So a piece of some of the assets are in Louisiana, and I represented the lender. So they were like, okay, they told the borrower, if you move those assets, it was like equipment, something, out of Louisiana, I'm going to give you a couple more basis points on your borrowing base. The only reason for that is because that even though it's part of the United States, but they have a very different legal regime in Louisiana, and investors, lenders don't like it. So it is kind of funny. They end up did that, and they got a couple more basis point on those assets. So it's yeah.
Well, you want to be able to enforce your rights, and if worst case scenario you have to exercise them, you want to be in a familiar jurisdiction where
for sure.
your GC and your advisors are able to operate.
You can even explain to your credit committee, right? Like investment committee, how step by step things will unroll.
Yeah.
And if it's a very exotic jurisdiction, it might, it might take time to convince your own committee even.
Yeah, you don't want to be the first.
Yeah, for sure. Or you can invite your lawyer to be in the conversation.
It's easier to get the lawyers to move to Cayman than Louisiana.
Yeah.
That's
Not
for
that there's
sure.
anything wrong with Louisiana.
Cool,
I like
though.
crayfish.
Yeah, yeah, I like that.
So following on that, appreciate the answer. If we were to kind of double click down a little bit further, are there specific operational or regulatory advantages of being in Cayman with these vehicles?
Yeah, I think there's a few areas where Cayman has really made a name for itself. So from a regulatory perspective, SEMA, so the Cayman Islands Monetary Authority, I think that they're firm but fair. So, you want a regulator that's obviously staying on the right side of global anti-money laundering and commercial due diligence. And SEMA definitely does that. It has a good reputation with the OECD. But it's also a business-friendly regulator. So, it's Goldilocks and the Three Bears. You don't want the porridge to be too cold.
Right.
You don't want a regulator that's too loose. But you also don't want the porridge to be too hot. You don't want a regulator that ignores the industry. And I think Cayman, of all the regulators I work with, it's one of the best in terms of towing that line. So both safe and also business friendly. Additionally, within the Cayman ecosystem, I think that there are service providers who are able to ensure that you are looked after and that transactions happen. So, we take on a lot of fiduciary roles. So we support over 1,200 fund structures in Cayman, many of which we act as directors. You want to make sure that you have officers and directors who have the experience to both discharge their fiduciary responsibility, so ensure that all of the due diligence and checks and balances are put in place, but also who can make sure that deals flow. And a degree of familiarity, having been on deals, having seen specific asset classes and specific situations, empowers directors to make those decisions safely but quickly. And I think that level of ecosystem, the ability to speak to quality attorneys, to have a registered agent that can do the do, and to have fiduciaries and officers who are able to comply with the regulations and make deals flow is a key advantage of Cayman. And from a regulatory perspective, it's also probably worth noting that Cayman continues to invest in its legislation when it comes to different types of structures that are available. So obviously there's the exempt company, which is kind of like the workhorse, I suppose, of Cayman. But there are also exempt limited partnerships, where you want the entity to be more of a pass-through, so less of a corporate identity, as well as things like segregated portfolio companies, which provide an extra degree of separation for entities and for assets. So, Cayman continues to listen to the market and to introduce entity types that will provide the onshore attorneys, who are really the true architects of these deals, the flexibility they need to come up with a structure that fulfills all of the obligations that the LPs and the GPs might have.
Yeah, I think 1 out of every 5 conversations about structuring in Cayman also follows on with, what is this segregated portfolio company? Should I be using that or should I not be? Right. It's so it's a known product that the U.S. market, the portfolio managers here in the U.S. know, like you said, that they're not just like resting on their laurels of the last 30, 40 years, but they're enabling the business side to actually take on these types of structures to aid them in what they need to do for their constituents.
Well, I mean, I think the offshore environment has changed drastically. Like even through my career over the last 20 years, Gone are the days where you can have a tin pot regime that just affords you with a letterbox and a name over the door. The jurisdictions that survive are the jurisdictions that evolve. And if a shark stops swimming, it drowns. The fact is that the regulatory and compliance landscape is becoming ever more complex. So if you're not keeping up with that, then you're going to fall foul of the OECD. You're going to get blacklisted. That's going to create even more investor reporting requirements and cause you problems. But equally, if you're not listening to the industry, if you're not creating structures that are dynamic and that fulfill the needs of your client base, then you're also going to fall out of favor. So I think Cayman's doing a good job of keeping abreast of both of those different headwinds. Excellent. Thank you both. So just in terms of wrap up, looking forwards, I'd be interested to hear what you think the next wave of private credit and fund structuring is going to look like. So maybe Ruth, I'll pose that to you first.
Yeah, sure. We kind of touched upon earlier. It's really the whole movement. It has been the private credit coming to mainstream, coming to the public side. So this is going to be a continuing trend, and that's going to be the force pushing forward all the revolutions and the way people structure deals. It's how tailored the private credit providers can be towards their borrowers. So I don't speak for Greenberg Traurig, but based on our experience and the current deals and the deals that we've done, this is a continuing trend. People are willing to really meet each other in the middle, come up with a covenant, package that makes sense, that give the lenders protection, but allow the borrower to do what they need to do. And in addition is the regulatory piece that will come at some point, and that will be something either it will provide general, not direction like not reshape, but it will really moving private credit,
bring it even more mainstream, right?
Yeah, but then I guess that's my personal struggle is like, how do they regulate it, but not like really putting them into the, like, other than the way they regulate banks, right? Like if they want to really, because the whole thing is about the exposure. The more credit private out there, then the more exposure, the economy gonna tank when that thing go upside down. So what can the government do? But don't put them into the box of banks. Allow them the flexibility, but can still take control.
I suppose it's not your problem what the government decides. The fact is, when it comes out, you'll be hand-holding your clients through it, right?
True.
Yeah.
True.
Well, they do have SEC, like as oversight is going to be happening, right? When you pass the 150 RAUM levels, which a lot of these groups do.
Yeah.
I think big picture, because as I said earlier, these private institutions came from the banking industry backing away after the GFC. And so a lot of private credit has been, in the early days, it's kind of odd because it's been larger groups, right? Think the KKRs and the Oak Trees and the Blackstones. And so these larger asset management firms really were there first because they had to fill the void that the banks made when they left. So what's been happening over the last, let's say, 5 to 7 years, right, the back half since GFC, is more lower middle market and middle market private credit shops have been proliferating. And so we see that trend continuing with a very high degree of specialization, right? Water rights, specific energy sources. This section of the lower middle market private company space where we're going to lend into maybe technology, which typically doesn't receive debt early on, right? We've seen venture lending funds proliferate over the last 7 years. So I think that is going to continue because it started almost the opposite of how the private equity market started, where you start with a really small company and it gets bigger. And so you got a lower middle market private equity fund feeding that company its equity. And in the credits, it kind of almost came about reversed.
Well, it's interesting because like the larger shops do have an advantage. in terms of bringing in the bigger LPs and the economies of scale. But to your point, having that level of specialism, able to better risk assess deals puts you in a position to really advantage yourself of a niche that other people might be less interested in or less able to take advantage of.
Yeah. And one thing you touched upon too is increasingly the structure is like a combo of debt and equity. We see a lot more preferred equity piece warrants built into it. So in a way, it also, as a practical matter, we've seen on those deals, your investors, your funds automatically has more transparency because you're semi-equity holder. So it's like a win-win situation.
Right. Yeah, certainly on the venture lending and then the early
Yeah.
stage growth lending, that definitely is the case.
For sure. Yep.
Great. Thank you both. So I suppose last question, if you were going to give one piece of advice to a asset manager in this space, what would it be?
For me, it would probably be similar advice to businesses in general. Like know your specialty, right? Don't stray. And if you have to wait to find that right company to provide that facility to, better to wait.
Yep.
The investors on the private credit side are a bit more patient and discerning with their allocation. So I think that they've got that opportunity to be very patient with deployment.
Measure twice, cut once.
Yep.
That's a good one.
And Ruth, from your perspective?
Continue being able to think out of the box. It is driven by the demand. We have so many more,
Right. Doesn't have to just happen with equity. It could be, you could use debt in a bunch of different ways.
Yeah.
Right?
Yeah, exactly. Yeah. And to your point, it's there's still so much ground to cover. It's still a lot of space to grow. So exciting to see what it will look like 5 years from now even.
Yep. Excellent. Well, hopefully we'll be here to see it.
Yep.
Well, I think that's probably all we've got time for. I'd love to thank my fellow panelists. So thank you, Ruth. I thought you did a great job representing Greenberg, speaking for Greenberg. And thank you, Vince.
Thanks, Jason.
Coming all the way up from Charlotte. That's, as I say, all we've got time for today. But great to speak about private credit. As we've discussed, it's a burgeoning field. Lots of interest from LPs looking to source interest into the area, and GPs who are building a huge degree of specialization in some interesting different asset classes. If you'd like to know more information, please feel free to reach out to Greenberg or to Ocorian, and we would love to discuss further. Thank you.
Thanks, Jason. Thanks, Ruth.
Thank you.